It's going to be worse than the great financial crisis. I'm your host, Steve Van Metre, and thanks for joining me today. And the fastest decline in homebuyer sentiment is bad news for the housing market and the big banks. Let's over to CNBC, where we picked today's story up with the headline that more home builders lower prices as sentiment falls for the 9th straight month. Homebuilder Sentiment in September fell 3 points to 46 on the National Association of Home Builders and Wells Fargo Housing Market Index. Anything below 50 is considered negative and on its way to even worse. And here we can see the NHB housing market chart, where I've drawn a line at today's level right around 46. And what you can see is in the past, when it gets down to this level, either we're at a bottom in sentiment or it's about to plunge much lower. And you can see, aside from the pandemic, the housing market is plunging at the fastest rate since the great financial crisis. And this spells really bad news for the banks, who are obviously lending in this environment, and the home builders who have built a lot of homes on the notion that if you build it, they will come. That is a nice straight month of declines in the lowest level since May of 2014, with the exception of short-lived drop at the start of the coronavirus pandemic in 2020. Sentiment was at 83 in January this year, notably when interest rates were about half of what they are now, which has been cited as the problem the housing market is facing. Indeed, builders blame rising rates for their falling sentiment. The average on the 30-year fixed rate started this year around 3% and then began rising steadily, crossing 6% for a few days in June, according to Mortgage News Daily. It then fell back a bit and almost hit 5% in August before rising sharply again, back over 6% this month. That made an already pricey housing market even less affordable. The Federal Reserve, meanwhile, is expected to continue raising rates this week as inflation remains high. And that's always what the story is with the housing market. Oh, well, it's got to be rates and people can't afford it. Prices are too high. They can't afford it. But, that's not exactly how we should be looking at this, because, yes, those things are true. Prices are high. Rates are high and people can't afford them. But if the economy was indeed booming, if we were really growing here, then higher prices and higher rates shouldn't be an issue. But the fact that they are an issue is telling us the economy is nowhere near as strong as believed. And what this translates into is what the banks are about to do, and that's tighten lending standards. And here you can see the net percentage of domestic banks tightening standards for commercial industrial loans, and using that as a proxy for the broad banking market against the Treasury yield curve, which is a 10-year Treasury minus a 2-year Treasury. Now keep in mind that the Treasury curve here is shown in red and is currently inverted. Now banks borrow at the short end of the curve and lend at the long. So when you see this thing inverted or about or below where that yellow line is drawn, well, it tells us that banks aren't making money when they lend, and that's why you're seeing financial conditions tighten, because what they want to do in this situation is only lend to the people they believe have a high degree of high probability of paying their loans back, and that starts to increase. I want to point out that tightening of banks increases as rates fall. So one thing that people believe is, oh, if rates come down, the housing market will boom. Well, not if the banks don't lend, and they typically don't. Buyer traffic is weak in many markets as more consumers remain on the sidelines due to high mortgage rates and high home prices that are putting new home purchases out of financial reach for many households. Nearly a quarter of home builders also report lowering home prices, up from 19% in August. And of the index's 3 components, current sales conditions dropped 3 points to 54, or slightly expanding. Sales expectations in the next 6 months fell 1 point to 46, showing a contraction, and traffic fell 1 point to 31, showing a steep contraction. And what's important here to understand is that when home builders start to cut prices, that means that resale market price cuts are coming next. It's always the home builders who are leading here. So as they get more desperate, and you can see in that traffic number that there's not a lot of traffic, saying they're going to slash prices more, and that's going to hit those who are in the resale market hoping to get out before it's too late. Builders continue to report elevated construction costs in addition to higher interest rates weighing on their market. Higher costs for land, labor, and materials have made it harder for builders to lower prices, but they're now being forced to. In this soft market, more than half the builders in our survey reported using incentives to bolster sales, including mortgage rate buydowns, free amenities, and price reductions. And yet Redfin predicts the sharpest turn in housing market since the 2008 crash of what is to come. But one thing that shouldn't take the sharpest crash should we enter another great financial crisis is your portfolio. I'll put a link up here to Portfolio Shield and the description below. Let's take a look and see what Redfin is worried about. And for the first time since March of 2021, the average home is now selling for less than its list price, but high mortgage rates are still impacting what people can afford. Mortgage rates are the highest they've been in 14 years, reaching nearly 6%, as we just talked about, and the sharpest turn in the housing market since the housing market crash of 2008. And that's the real concern here, because the housing market is a big driver of the U.S. economy. You have high rates, that means people in the mortgage industry are likely to lose their jobs. You have a decline in sales, so realtors are likely to have far less transactions. You have builders who are not building as many, and there's just a lot fewer jobs that are needed, and that puts a lot of people either on the unemployment line, or worse, if they're self-employed, well, they have no safety net other than their own savings. While home prices are still higher than a year ago, with the average home now selling for just under $370,000, inflation and interest rates are slowing down the market. We haven't seen interest rates this high since 2008, 2007, so it's a big change from the housing market we've all gotten used to. And with these higher rates, mortgages are up about 40% from a year ago, meaning if you bought a house today from a year ago, well, that means you're paying 40% more for that mortgage. And this is really the impact that the Fed has. When we talk about what the Fed can and can't do, a lot of people say, well, they can print money. No, they can't do that. But they can impact the credit markets, and by raising rates, they pull back on those demand rates, and they try to throttle demand back. And here you can see it in the housing market is a perfect example. Higher rates, well, the economy is not strong enough to absorb them. So what happens? Demand falls, price starts to fall, and then next thing you know, you get a domino effect from there. Buyers just don't have the 40% extra money to put towards housing every month. A lot of home buyers had to drop out and go to the rental market instead, or choose not to buy that second home or invest in property. And Redfin also said now it's still a good time to buy if you qualify for a mortgage, because you can always refinance when mortgage rates go down, except when financial conditions tighten. If you find a house that meets all your needs and you're going to stay in for at least 5 years, it's still a great time to buy. And when asked if we could enter another housing financial crisis, Redfin said it's unlikely. Well, I'll leave this one to you in the comments. Do you think it's a great time to buy? Do you think there's an unlikely chance of another financial crisis? Hey, maybe if you just hold 5 years, it'll work, but we'll look to see what you have to say. Fairweather said if we do enter another recession, home buyers need to consider they'll still be able to afford their home if they unexpectedly lose their job. Well, that is not unexpected. It's highly likely, because when we go back to the yield curve, the 10s minus the 2s, and we overlay the 4-week moving average initial claims, what we can note is when the curve starts to steepen, the red line starts to rise, meaning rates are falling, which many believe is often good for the economy and the housing market. Well, the opposite happens. You notice that initial claims, that 4-week moving average, it starts to rise and head higher, right in line with the curve, suggesting that no, the situation that isn't that rates at this point are good. What's happening is financial conditions are tightening and the economy is entering recession. And that's why the yield curve is so important to understand, because it's telling us exactly what is likely to come, not where we've been. And with consumers now, they're in actually pretty bad shape going into another downturn. So it's not just high housing prices that's going to be a problem, it's in fact their overall budget. As more Americans are now stuck with long-term credit card debt, with some 60% of card debtors owe debt for 1 year or more. 60% of credit card debtors say they've been in credit card debt for at least a year, up from 50% a year ago. The share of those who have been in debt for over 2 years also increased to 40% from 32%, according to the online credit card marketplace creditcards.com. With inflation exceeding wage gains, more households have relied on revolving debt. Consumers in their 20s and 30s and those in the lowest income brackets are more likely to carry a balance to cover daily expenses such as groceries, childcare, or utilities than older generations. So here again, we see more evidence that the reason people can't afford higher home prices and higher interest rates is because they can't afford even basic needs, because the economy is not doing as well as policymakers keep telling us it is. They keep telling us, hey, it's going to get better, it's going to boom, or it is booming, you just don't see it, it's coming. But the data says no, because people don't normally carry balances that long. They like to pay them down, and in this case, they can't afford to. About a quarter of respondents said day-to-day expenses are the primary reason why they carry a balance. Almost half cited emergency or unexpected expense, including medical bills and home or car repair. And the Federal Reserve is likely to raise rates for a fifth time this year next week, with a high probability of a 75% or 75 basis point hike. And with credit card rates typically directly tied to the federal funds rate, and their increase along with softening economy may lead to higher delinquencies. In fact, it's not may lead to, is most likely to lead to. And the global race to hike rates tilts economies toward recessions, as the Fed is willing to tip the U.S. into a slump if that's what's needed to beat inflation. About 90 central banks have raised interest rates this year, and half of them have hiked by at least 75 basis points in one shot. Many did so more than once in what Bank of America chief economist labels a competition to see who can hike faster. The result is the broadest tightening of monetary policy in 15 years, a decisive departure from the cheap money era ushered by the 2008 financial crisis, which many economists and investors had come to view as the new normal. The current quarter will see the biggest rate hikes by major central banks since 1980, and it's unlikely they'll stop there until something breaks. So I want you to see, we went from ultra loose policy globally to ultra tight policy. The notion is that, hey, we're just going to have this nice, smooth, soft landing. Reality is the plane is going to go nose down right into the ground. And it's going to come with some pain, as this week alone the Fed is set to lift rates by 75 basis points, with some calling for a full percentage point. But keep in mind, 75 basis points is priced in, the full percent is not. The Bank of England is also predicted to boost its benchmark rate by 50 basis points, and hikes are also expected in Indonesia, Norway, the Philippines, Sweden, Switzerland, and more. And as they slam on the brakes, policymakers are starting to lace their language with gloom, and a public acknowledgement that higher they raise rates to quell inflation is a bigger risk they harm to growth and employment. And that's what baffles me when you hear from that Redfin report and say, hey, it's a good time to buy as long as you don't lose your job. Meanwhile, central bankers are saying, hey, you're probably going to lose your job because we're going to keep dying until we break inflation. And guess what? The only way that happens is stocks come down and you lose your job and stop consuming as much. And for the banks, that's bad news, because once again, here they are out lending at the forefront of what likely is going to be another great financial crisis. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.